Happy Friday, everyone, and welcome back to Your Finance TV. As you know by now, it's Musings Times with Jay Pelosky. How are you, Jay?
Great, Scott. It seems like we just talked to each other a few days ago.
Well, it's been a very special week. I get you twice this week, right? I had you on Monday to go through your monthly and year ahead outlook, which has been very popular for views. And now we get through your weekly musings. Aren't I, lucky fella?
You are indeed.
Now, the title for your musings this week is Fear is Everywhere, and it's quite an apt title considering the amount of people I've spoken to this week who are petrified of different things that are happening in the market and what could potentially happen going ahead. I obviously directed them to the video last week, but run me through your thoughts on this fear is everywhere, because is it really that scary?
Well, I mean, the title actually comes from a Bloomberg article title that I saw earlier this week, and it grabbed me because it was so definitive, right? Fear is everywhere. And, today, as in many things, you can choose your own kind of story, your own reality, your own media bubble, right? You can choose how to self-medicate with all sorts of things that were illegal, a couple of years ago. A friend of mine telling me about ketamine the other night. And I'm like, what? I thought that was illegal. And oh no, it's very helpful for you. So now that we have all these things and all these abilities to kind of choose your own story, it just strikes me that there's such a dispersion in views within the market. So fear is everywhere is definitely right there, right? And we know that blood sells and media needs to find eyeballs. But then you contrast it with Goldman Sachs came out a day or two later with their 2024 outlook. And their title was The Hard Part is Over, arguing that the Fed is done, that disinflation is going to continue, that there's only 15% chance of a recession over the next year. So that's kind of pretty constructive, right? And then there's us. As you pointed out, we did our 2024 outlook last week, and we kind of planted a flag in what we call the stable land. In other words, after years of upheaval and volatility and Fed rate hikes and inflation spikes, we think we're approaching stability. And so we're obviously at the more constructive end of things, which, is kind of where we typically find ourselves, right? If you recall, 15 months ago, we were talking about the middle path between high inflation and recession when 100% of economists were forecasting recession by now, right? So we're comfortable being in that constructive zone, that constructive camp, and we think the market and market participants are going to come in our direction over the coming year, much as they have over the last year, going from 100% recession to now Goldman saying 15% in the next 12 months. But it's just a really fascinating time with such a dichotomy and widespread of views that I think there's real value in having a framework and a process and a point of view that you can articulate.
Yeah, and it's great. Like, your musings are fantastic to the viewers. It's fantastic for me personally as well to go through that. And the way you break it down is like you go through your process, you go through your framework. And I think it's an important thing to remind the viewers how you actually do that and how it works with TPW.
Yeah, it's interesting. I write about it a fair bit in this musings because these weeks are busy weeks, right? Every Friday, as you know, and as your viewers hopefully know by now, we write a musings, 1,400, 1,500 words, our top of mind thoughts. At the end of every month, we kind of come together and do a deep dive monthly. Last month was the outlook last week, and that was 6,500 words with 30 charts and tables from over 16 different independent sources of research. So that's a big lift, right? But what it does is it allows us to make sure that we have a comprehensive point of view towards the markets and global multi-asset macro markets, which is what we focus on and is kind of our area of expertise after 35 years in the business. And so then we take that monthly, that deep dive, and we update our two model portfolios. And that was what we did this week. So our global multi-asset, our TPW 20 thematic model portfolio, this week is the week that we update them. And in addition, when we update them, we send each client a client update that typically runs around 1,300 words. So in the last week alone, Friday to Friday, we've written about 9,000 words on the markets, which is a lot, right? And at the same time, we've had a really interesting kind of social media, video, TV week where, as you pointed out, we did our video on the 2024 outlook on Monday. On Tuesday, we had a hit with a Spanish business channel. On Wednesday, we were down at the stock exchange for a live hit with the folks at Schwab. And then we finished it up with a solo guest segment on BTV's The Open Show one morning this week. So the combination of all that written work plus all that, TV video work really forces you to kind of have a concise and fluid point of view that you can articulate right on TV or in these videos. Here are the videos. It's a much better opportunity for us to go back and forth. TV is obviously much more of like a 30-second, 50-second kind of soundbite, but that has real value to force you to distill, into a 40-second, answer to a question you don't know what the question is before it's asked, forces you to kind of have that work at your fingertips. And so for me, I find that really valuable, and it leads the combination of the written work, the model portfolio update, and all the social media, TV, video means that I feel like we have a very concise, very clear perspective on what we think is going to unfold in the coming year.
Okay, well, you talk about that net result, and you've got a pretty clear view of it. What is the net result? You can't tease the viewers like that, Jay.
You're supposed to at least give me 10 seconds to have a little bit of water.
Well, see, I've got to know. Like, the viewers have got to know. I've got to know.
Yeah, you've got to know. I like that. I appreciate that. So here goes, okay? So we're constructive on the outlook for 2024. Well, first of all, let's break it down into two parts, right? Now and year end, and then 2024. Between now and year end, we are quite constructive on risk assets for a rally into the end of the year. We think there are four factors that are lining up to support this. And my way of thinking is that when you have two or three, then you can start getting excited. When you have four things that you can use as reasons for something to happen, that's pretty confident, right? That's like a 5-star type rating. Okay, so the four are seasonality, right? November, December, the two best months for stocks historically. Sentiment. Last week, the AAII bull-bear ratio was the most negative in a year. So that's second. Positioning. Retail traders sold more stock in October than they have at any month in the past 2 years. Hedge funds, net long, is at a 5-year low. And CTAs are completely offsides and have to buy back between now and the end of the year. I've seen estimates range up to $150 billion of stock. So that's 3, positioning. And then 4, technicals, right? Where all the technicians that we follow were going bananas last week because we had several very rare breadth thrusts, which the hit ratios going forward on a 6 and 12-month basis are extremely compelling. And then to add on one more, why not have one more, right? November and December are also the best months for stock buybacks. So when we look at this setup, right, and we know how the story goes, right? You and I have both been in the markets a while. Hedge funds first have to cover their shorts, right? So last week, Goldman Sachs short interest basket was up 17%. You think some hedge funds aren't feeling the pain? 17% in a week. All right. So then they get long. Then the CTAs come in. Then the active managers who are underperforming because they've been in cash, right? And they have the gate at the end of the year when their performance is going to be measured. Most are measured on a 12-month basis, ending on the calendar year. So real incentive for active managers to get involved. And then you have the retail traders coming in, buying back the stock that they sold in October. So really, when you put it all together, it's classic year-end rally type activity. So we're quite constructive between now and the end of the year.
Okay, so once again, we take all this sort of information in. How do you position yourself? Like, how does the average Joe Blow out there position themselves? Like, what things are you doing to your model portfolio that they might take some interest in?
Well, I mean, I think before we get to that point, right? First off, given what we just talked about, you want to be invested, right? So you need to be invested in the marketplace. So days like yesterday, where Chair Powell comes up and wipes the grin off the face of everybody who was enjoying the 8-day S&P rally, those are days to put money to work, right? So that's point one. When you think about how to position, we look 12, 24 months in advance, right? And we talk about how not trying to market time, right? And not being happy that we don't have to decide when to shovel a bunch of cash into the markets, because we've ridden through the last 3 months pretty fully invested, right? So that last 3 months, not exactly pleasant, but after last week's rally, the net drawdown from the July high is 4%. Is that within the realm of acceptability? Absolutely. So when we think about positioning for the next year, we want to think about what's the macro backdrop. So just to quickly revisit what we talked about on Monday in the 2024 outlook, 4 macro surprises, the biggest of which is lower inflation sooner than expected, right? So the Fed and the ECB don't have 2% type inflation penciled in until 2025. We think it's going to happen next year. That's going to give the Fed room to perhaps make some insurance cuts to keep the economy going forward, right? So that's a constructive environment. Lower inflation sooner than expected leads to lower interest rates, which leads to a weaker dollar, and that sets up all sorts of opportunities. The other factor, the other big surprise, is that macro stability, right? And so we look at things like, as an example, give you 2 economic and 2 market. The economic are, you look at retail inventories in the retail sector in the United States. Years of craziness with COVID and supply shutdowns, et cetera. Now, completely back to normal. Then you look at the supply chain issues. Again, very much affected by COVID. New York Fed does a really nice global supply chain pressure indicator, completely flat, back to normal. So then we look at markets. Look at the VIX. The average year to date, 17.5. Guess what the 30-year average is? 17.5, right? If you look at the S&P year to date, up about 14%. What is the historical average for the S&P in a third year of a presidential term? 15%. Right on average, right? So we think you can really make a case that we are in that stable land, as we call it. And remember, the big opportunity is the $1 trillion reward unlock, right? When you get to that stable land, there's $1 trillion plus that went into money market funds this year that we think is going to come out. And as we return to stability, folks are going to want to get more invested. So when we look at those factors, then that's all, that's quite compelling to us. And so we want to be involved in the markets. And that's what, when we went through our model portfolios this week, that was our takeaway, right? We want to make sure that this line of thinking is expressed in the models.
And that people can go to Pelosky.com to sign up for those musings and so forth. This is a reminder for everyone watching there as well. Jay, listen, thanks so much. Great week. Great rundown for us. I presume you got a quiet weekend. You don't have much to do this weekend?
Well, it is actually a busy weekend. My younger son is playing in his football championship game later on this afternoon, so we're going to be hitting the road soon after we say goodbye to each other. And then, of course, our Duke Blue Devils do play arch rival North Carolina tomorrow night. So, as the saying goes in Durham, nothing could be finer than beating Carolina. So, go Duke.
All right. Well, good luck to your football team, and good luck to your son as well. And you have a great weekend.
All right. Thanks, buddy. You as well.
And for everyone else out there, good luck investing.